One of the most confusing moments for homeowners is when they see their mortgage payment change, even though they have a fixed rate mortgage. And their immediate reaction is usually, wait, I thought my payment was fixed. And honestly, I completely understand why people think that. But what most homeowners don't realize is your mortgage payment and your mortgage rate are not always the same thing. And understanding escrow is what makes all of this finally start to make sense. So in this video, I'm going to break down what an escrow account actually is, why lenders collect prepaid taxes and insurance at closing, what reserves are, why your payment can increase even with a fixed rate, and whether paying taxes and insurance yourself is actually a better idea. And I'm going to show you a real payment breakdown in a minute so you can see exactly where every dollar goes. Because once people understand escrow, a lot of the confusion and stress around mortgage payments completely disappear. Let me start with this. Escrow is one of those mortgage topics people nod along to during closing, even though they don't fully understand it. And honestly, that's not their fault because most people hear words like escrow, reserves, prepaids, and their brain immediately goes, okay, I'll pretend I understand this and figure it out later. Then later comes, and now they're wondering, why did I pay taxes twice at closing? Why did my payment increase? Why is the lender holding my money? And once you understand how escrow actually works, it all becomes much less intimidating. And if you're trying to understand the financial side of homeownership more clearly, I've got a 90-day homeownership game plan in the description that helps you simplify all of this step by step. Let's simplify this first. An escrow account is basically a savings account managed by your mortgage company. Its purpose is simple: to collect money monthly for property taxes and homeowners insurance. Then your mortgage company pays those bills on your behalf when they come due. Here's where most people get this wrong. They think escrow is some extra fee. It's not. It's simply your taxes and insurance broken into manageable monthly payments. Think about it like this. Instead of getting hit with 2 large property tax bills each year, plus 1 large homeowners insurance bill, you're spreading those costs over 12 months. And honestly, for most people, that makes life easier because those bills can be substantial. Escrow is designed to turn large irregular bills into smaller manageable monthly payments. Now let's look at what a real payment actually looks like, because this is the part that finally makes escrow click for most people. Let's say someone buys a home for $550,000 and their loan amount is $500,000. Their monthly payment might look something like this. Principal and interest, $3,038 a month. Homeowners insurance, $133 a month. Property taxes, $145 a month. And mortgage insurance, $103 a month. For a total monthly payment of $3,419 a month. Now, here's the important part. Only the principal and interest portion is tied directly to the fixed rate. The taxes and insurance portions, those can change over time. And this is the moment most homeowners suddenly realize, oh, okay, that's why my mortgage payment changed. Your interest rate may stay fixed, but the taxes and insurance can still change your total payment. If this is helping you finally understand how mortgage payments actually work, go ahead and subscribe. My goal is to make this process feel clear and manageable, not confusing or overwhelming. Now let's talk about one of the biggest confusion points during the closing: prepaids and reserves. I've had so many conversations with buyers reviewing their closing disclosure and saying, wait, why am I paying taxes and insurance already if I'm also paying monthly escrow? That's a great question. Here's what's happening. At closing, the lender needs to set up your escrow account with enough money to start covering upcoming bills. That means collecting prepaid homeowners insurance, prepaid property taxes, and reserve amounts, also called escrow cushions, because the lender needs enough funds available when those bills come due, especially if your taxes are due shortly after closing or your insurance renewal is approaching. This is the part nobody explains clearly. You're not paying the same bill twice. You're funding the account up front and continuing monthly contributions moving forward. Think of it like setting up an emergency savings account. You don't start at zero and hope the bill doesn't show up. Prepaids and reserves exist to make sure your escrow account has enough money to pay future bills on time. This is probably the #1 confusion point. People think, I have a fixed rate, so my payment should never change. And that sounds logical, but it's only partially true. Your principal and interest payment, that stays fixed, but your property taxes and homeowners insurance can change over time. If your county raises property taxes, or Insurance premiums increase. Your escrow account now needs more money to cover those higher bills, which means your monthly escrow portion increases. And this is where homeowners often panic unnecessarily. They think, the lender randomly raised my payment. Usually, the lender is adjusting for higher taxes or insurance costs. Each year, your mortgage company performs an escrow analysis. They compare what was collected versus what was actually paid out. And if there's a shortage or an overage, your payment may adjust. Fixed rate mortgages fix your interest rate, not your taxes or insurance costs. Now let's talk about a common opinion people have. I don't want the lender holding my money. And honestly, for some people, paying taxes and insurance yourself can work just fine. If you budget extremely well, save consistently, and are very organized, you may prefer handling those bills on your own. But here's how to think about this realistically. Those are big bills. You're talking 2 property tax payments per year plus an annual insurance premium. For most people, breaking those costs into 12 monthly payments is simply easier to manage because the goal isn't just financial optimization. It's reducing stress and creating predictability. Escrow often makes budgeting easier because it spreads large expenses into manageable monthly amounts. And if you're trying to better understand how your mortgage payment is structured or why your payment changed, this is exactly the kind of thing I help homeowners walk through every day. If you're thinking about buying or refinancing and want clarity on your specific situation, I'd be happy to help. There's a link in the description where you can schedule a time or grab one of my free guides to get started. Let me leave you with this. Escrow accounts are really designed to help you manage your homeowner's insurance premiums and property taxes in small, manageable bites. That's the goal, not confusion, not hidden fees, not some trick. Just structure and predictability. And when you actually understand where your payment goes, how escrow works, and why changes happen, homeownership starts to feel a whole lot less stressful and a whole lot more manageable. So if you've ever looked at your mortgage payment and thought, why is this changing if I have a fixed rate? Hopefully now it finally makes sense. Understanding escrow isn't about becoming a mortgage expert. It's about feeling confident enough to understand your own money. If this helped you feel more confident about how your escrow works, make sure to subscribe. And if you want to keep learning, check out one of these next videos.